Welcome back, traders, to the Trading Psychologist. If you have ever attempted to scalp gold, you already understand that it is incredibly fast-paced, aggressive, and entirely unforgiving. A single incorrect entry can lead to an instant exit from the market. In today's video, I am going to reveal my 3 most potent gold scalping strategies that perform flawlessly on both the 1-minute and 5-minute charts. These are the specific setups I would depend on if I were required to trade gold every single day. Each strategy is constructed upon clear mechanical rules, and I will break every one of them down for you step by step. By the conclusion of this video, you will possess a comprehensive roadmap to scalp gold with confidence and ease. Let's dive right into it. Understanding the gold market, XAU/USD. Before we jump into the specific scalping mechanics, we must first understand the nature of the gold pair. In the forex world, gold is traded as XAU/USD, which represents the price of gold as quoted in United States dollars. In the cryptocurrency market, exposure to gold is available through various tokenized assets, such as Pax Gold or Tether Gold. These assets are backed by physical gold and are traded against major cryptocurrencies like Bitcoin or stablecoins like USDT. Because of its high levels of volatility, deep liquidity, and frequent price fluctuations, gold has established itself as one of the most popular assets for traders. This is especially true for those utilizing short-term strategies like scalping. While I often prefer strategies based on liquidity sweeps for forex pairs, like EUR/USD, or stock indices like the S&P 500 and NASDAQ, the gold pair behaves differently. It is highly likely to react to and respect major technical areas. Specifically, gold frequently swings between key higher time frame levels, supply and demand zones, order blocks, and fair value gaps. Therefore, to build an A+ scalping strategy, we must capitalize on this behavior. Our primary focus will be on scalping strategies that utilize higher time frame delivery as the core confirmation criteria. Now, let's move into our first scalping strategy. Strategy 1. Higher time frame, liquidity, and order blocks. To execute this strategy correctly, you need to monitor 2 different time frames. First, you utilize a higher time frame to analyze the broad market condition. On this chart, your goal is to identify a liquidity sweep, a break of structure, BOS, and the order block associated with them. Once these are identified, you zoom into a lower time frame to track the delivery of that higher time frame move. Here, you look for specific reversal or confirmation signals. This is the stage where you wait for your entry model to manifest before opening a position. Let's break this down step by step. Your first task is to identify a key liquidity sweep, also known as a liquidity grab, alongside a break of structure on the higher time frame. While this can be done manually, for this demonstration, we are using the price action toolkit indicator to automate the process. In a bullish scenario on the higher time frame, the first thing you want to spot is a bullish liquidity grab. Simply put, you are looking for the price to dip below a key level, reverse immediately, and then confirm that reversal with a break of structure. Using the price action toolkit, you can enable liquidity grab in the settings. Bullish grabs appear as small green circles, while bearish ones appear as red circles. You should also activate the BOS and CHOCH, change of character, checkboxes. In our example, we see a bullish liquidity grab, where the price sweeps below a recent key swing low, shows a forceful rejection to the upside, and finally results in a bullish break of structure. The next step is to mark the specific order block that initiated both the liquidity grab and the subsequent break of structure. This area now serves as your higher time frame point of interest, POI. Price frequently revisits these blocks, which then act as demand zones where institutional smart money re-enters the market. For clarity, order blocks are decisional zones where massive trading volumes are placed right before a significant price expansion. Because of this concentrated volume, price often reacts or reverses when it returns to these specific areas. In a bearish context, a bearish order block is the final up-close candle, or series of candles, formed immediately before a strong downward move that breaks structure. Conversely, a bullish order block is the final down-close candle formed just before a powerful upward move. After you have marked the order block, you simply wait for the price to return to that specific zone. This is where your potential trading opportunity begins to take shape. Once the price enters the order block, zoom into your lower time frame. Closely monitor the price action for reversal signs, such as a market structure shift, a change of character, or other signals like inversion fair value gaps, IFVG, or V-shaped recovery, VSR patterns. We are specifically looking for a violated fair value gap that transforms into an inverse fair value gap, IFVG. This acts as our primary confirmation. Once an IFVG forms, it often functions as a new support level, providing a sturdy area for a potential buy entry. If a market structure shift occurs simultaneously, it adds a powerful layer of confluence, making the setup significantly more reliable. We then expect the price to retrace into the IFVG, now acting as support, before continuing toward the next pool of buy-side liquidity. Regarding entry execution, you have two primary options. Note that you can always add more confluence factors, like a V-shaped recovery, or a change in the state of delivery, though adding too many filters can sometimes cause you to miss fast-moving trades. The first entry option is to enter the market immediately after the IFVG forms. You would open the position at the start of the next candle, placing your stop loss below the most recent swing low. The second, more conservative option is to place a buy limit order at the highest point of the newly formed IFVG. You then wait for the price to retrace into the zone to activate your position. This often provides a superior risk-to-reward ratio. For your take profit, you can target the nearest buy-side liquidity on your current time frame. If you are looking for a more significant move, you can target a key level on the higher time frame instead. If the price has already started moving in your expected direction and your first position is in profit, you can look for a continuation setup. This occurs when the price forms a new bullish fair value gap during the next leg up following a new break of structure. In this scenario, the next unmitigated bullish FVG becomes your second entry point. You can place a buy limit order at the top of that gap, with the stop loss set a few pips below the most recent swing low. The exact opposite logic applies to bearish trades. To achieve the best results with this plan on gold, I recommend using the 30-minute or 15-minute charts as your higher time frames. Once the setup is identified there, move to the 5-minute or 1-minute charts to execute the entry. Strategy 2. Supply/demand and breaker blocks. The second scalping strategy utilizes the 1-hour and 5-minute charts. We use the 1-hour chart to analyze the general market condition, specifically looking for high-quality, unmitigated supply and demand zones. We then zoom into the 5-minute chart to track the delivery and look for confirmation signals. Your entry model must appear on this lower time frame before you open any position. In a bullish scenario, your first step is to confirm that the market is in an uptrend and that buyers are firmly in control. To verify this, you need to identify at least 2 consecutive bullish breaks of structure, BOS. Once the price has formed 2 successive bullish breaks, shift your focus to the most recent one. Trace back to the origin of that specific expansion move, the move that actually caused the break. That origin point defines your demand zone. Highlight the most recent unmitigated demand zone on the 1-hour chart and wait for the price to return to it. When the price taps into that zone, move to the 5-minute chart to monitor for signs of a reversal. Your first layer of confirmation on the 5-minute chart will be a market structure shift or a clear change of character. This shift indicates that the temporary bearish pullback is concluding and that bullish momentum is returning to align with the higher time frame trend. Once the bullish market structure is confirmed, we look for our entry model. For the first entry, I prefer to find a bullish breaker block forming inside that higher time frame demand zone. A valid bullish breaker block is formed when the price creates a swing low, followed by a swing high and then a lower low. We then need to see an immediate strong expansion to the upside that breaks the previous structure. The up-close candles formed between that first swing low and the swing high represent your breaker block zone. This is where you plan your long entry. You can mark this manually or use an indicator to highlight it automatically. Set a buy limit order at the highest point of that breaker block and wait for a retracement. Your take profit should target the nearest liquidity on the 5-minute chart or a major higher time frame level for a larger target. If the trade is already in profit and the price creates a new break of structure, you can add a second position. This continuation entry is placed at the next unmitigated bullish fair value gap, formed within the new expansion leg. Place a buy limit order at the top of that FVG, with the stop loss set a few pips below the most recent swing low. As always, the logic is simply reversed for bearish scenarios. Strategy 3. Trend reversals and inversion gaps. The third strategy follows a similar 2-time frame approach. You start with a higher time frame, such as the 4-hour or 1-hour chart, to analyze market structure and identify a clear change of character, CHOCH. You are also looking for the formation of an unmitigated fair value gap tied specifically to that change of character. Then, you zoom into the 15-minute or 5-minute chart to look for reversal signs in your eventual entry model. First, determine if the price is in a strong trend on the higher time frame. To confirm a strong downtrend, the price must form at least 3 consecutive bearish breaks of structure. For a strong uptrend, it needs 3 consecutive bullish breaks. Once a strong trend is confirmed, you look for a higher time frame change of character. In a bullish scenario, if the price breaks and closes above the most recent BOS high of a downtrend, it signals that sellers are losing control and a trend shift is likely. After this shift is confirmed, identify a bullish fair value gap that formed within that specific CHOCH leg. Then, zoom into your lower time frame and wait for the price to return to that higher time frame FVG. As the price enters the zone, monitor it closely for any signs of rejection. This confirms that the market is respecting the higher time frame imbalance and serves as your first layer of confirmation. Next, look for a violated fair value gap that flips into an inversion fair value gap, IFVG. This can happen either inside the higher time frame FVG or just outside it following the rejection. This is your second layer of confirmation. When this inversion gap forms, it typically acts as a new support level. This is the precise area where you should begin looking to open your long position. For the execution, you again have 2 options. You can enter immediately after the IFVG forms inside the higher time frame gap, opening at the start of the next candle with a stop loss below the recent swing low. Alternatively, you can place a buy limit order at the highest point of the newly formed IFVG and wait for the price to retrace into it. Target the nearest buy-side liquidity on the current chart or a major higher time frame key level. You can further refine this by adding extra confluence, such as requiring the price to fill at least 50% of the higher time frame FVG or waiting for a change in the state of delivery, CISD, before entering. That concludes our guide, traders. I truly hope you found these gold scalping strategies valuable. If you did, please hit the subscribe button and turn on notifications so you never miss an update. Feel free to drop a comment below with your thoughts or any topics you would like us to cover next. Your support is greatly appreciated. See you in the next one.